All right, we're going to get things going here. Looks like we have close to 100 people live, so we appreciate you all being here live today. And again, there will be a recording in the next 3 or 4 hours. Once it's processed, it'll be on groupdentistrynow.com. So again, welcome to the Group Dentistry Now DSO Study Club webinar series. This is the Practice Valuation and 2022 Looming Changes webinar. We do have a area where you can ask questions, although it looks like almost everybody that has registered for this at least had one great question. Won't be able to get to all those today, but we're going to narrow it down, and we've got some great discussion topics really wrapped around what's occurred really post-pandemic. So when practices started to open up in mid-2020, what 2021 looks like, and then a little later on in the webinar, we'll talk about potential changes in 2022. So we are well over 100 now. I'm going to get going here. I want to introduce myself briefly. I'm Bill Newman, the CEO of Group Dentistry Now. I've been in the dental industry since 2003. I was a dental sales rep, worked for a dental manufacturer for quite a while, had a couple of my own businesses. One I sold to a media publisher and got into the publishing arena. And then with my partner, Kim Larson, started Group Dentistry Now in 2014 and have been in the space ever since. I feel fortunate to be here and really excited to talk to this great panel. So Dr. Rowe, please take it away. This is Dr. Roshan Parikh.
Hey guys, Roshan Parikh or Ro. I'm dentist by profession, and now serve as chief strategy officer for DSO strategy. Previously I in Chicago founded and helped build a DSO that has private equity, got some private equity sponsorship and recapped the business along the way. And then my last role was at Walmart as a head of dentistry for Walmart US and Walmart Health. And Walmart Health is a multimodality primary care center, medicine, dentistry, optometry, audiology, behavioral health. So was helping form the strategy, refine the strategy, and operationalize the business from the ground up. So, but happy to be here.
Thanks, Rob. Next up, we have Rich Blann. Thanks, Rich.
Good afternoon, everybody. Rich Blann here. I'm a managing director at Cantor Fitzgerald, and I lead our firm's advisory efforts across the retail, multi-site physician practice management space. Spend the vast majority of that time advising in the dental industry, but also cover a couple of other specialties that are emerging, but certainly far behind in terms of the level of activity in the DSO space. I've been an investment banker for over 20 years. Started my career with a couple of global investment banks, Lazard and Wasserstein Perella, and then returned to banking after my MBA, and have covered a lot of sectors over the years. I transitioned into healthcare about 10 years ago, and have been very, very deeply involved in the DSO space since then. And then I'll give a little background on Cantor Fitzgerald as well. So if we could flip to the next page. So institutionally, Cantor Fitzgerald, we're a global investment bank. We've been around 70 plus years. We're the largest privately owned investment bank on Wall Street. We're very proud of that. And from a banking perspective, we're one of the leaders in the healthcare space. We have one of the largest healthcare dedicated teams on Wall Street. And we do M&A advisory, debt advisory, equity raising, public markets, private markets, and strategic advisory. So we can provide the full spectrum of services and products to our clients in the dental space and beyond. So thank you for having me, and look forward to the panel.
Next up, we have David Pegg, the Chief Development Officer of Dental Care Alliance. Hi, David.
Hey, Bill. Thanks. Good to be with everybody today. Good to be with Jake and Rich and Ro and yourself. Appreciate you having me. So I'm the Chief Development Officer at Dental Care Alliance. DCA is today represents a little over 330 practices across 20 states, and also happen to be celebrating our 30th anniversary this year. So big milestone for the company. Prior to arriving at DCA as the CDO, I spent close to 20 years crossing paths with the likes of Rich in the private equity world, where I was a partner and historically invested in multi-site healthcare services businesses. Certainly last 4 years have been a change of scenery, a different experience working inside of a company rather than investing in one. But it's been a great 4 years, been a great experience thus far, and really looking forward to the remainder of 2021 and beyond. So thanks for having me.
Thanks, David. Last up, but certainly not least, we have Jake Berry, Chief Development Officer at MB2 Dental. Thanks for being here, Jake.
Yeah, Bill, thanks for having me. Good to be on with everybody. Just a few snippets on myself, I guess. I've been with MB2 since the beginning of 2017, back when MB2 was all doctor owned. Over the last 4.5 years, we've successfully had 2 financial partners now. So I've kind of seen the early inception of MB2 to where we are today. When I was first joined to the company, it was just a team of 1. Now we have a team of 13. So I appreciate the perspective I've had here with MB2 over the last 4.5, 5 years. Prior to that, I worked in a boutique investment bank here in Dallas, working exclusively within healthcare, always on the buy side. So a lot of that experience, while in different areas of healthcare, I think translated over here to MB2. Many of the folks on the call are probably familiar with us. Some may not be. We are a doctor-founded, doctor-led group. Dr. Villanueva is the founder CEO. MB2 was started back in 2007. We are now at 320 practice locations in 31 states. If you flip to the next slide, Bill, I'll use that to just highlight the model. We do like to use this Venn diagram as a simple illustration of what sets us apart, and Dr. V's early kind of thoughts on the benefits of our model and drawing really the best of both worlds from both private practice and organized group dentistry, and making those benefits available to all 230 plus dentist partners of ours now.
Excellent. Thanks, Jake. So just a quick shout out, and first off, appreciate all the attendees, again, taking time out of their day, and the panelists, and also like to thank Patterson Dental for sponsoring this webinar. Without them, we wouldn't be able to do this. So thanks, Patterson. I'll have Nick Abruzzo's email address if anybody wants to reach out to Nick at Patterson Dental. He heads up their strategic markets division. And we were all talking just before we jumped on this call. It sounds like everybody, including Nick, will be at the Dykema meeting next week. So if you're actually looking to meet David Pegg or Dr. Rowe or Rich or Jake, myself, or Nick, we will all be in Denver next week. So it's great to see that everybody's getting out again and getting a chance to rub elbows. So, all right, we're going to stop the screen share a little bit, and you, like it or not, you're going to see our faces a little bit bigger. First topic, we'll talk a little bit about last year. So let's think back to when practices reopened. So kind of mid last year. What did the market look like? What did M&A activity look like in 2020? And then what does it look like in 2021? So I know that's kind of a big discussion topic. And then we're going to hold off what's going to happen in 2022 till a little bit later. David, I'll kind of let you start things off.
Sure. So I guess I'll start with the second question first, if that's okay.
Sure.
2021 feels a lot like 2019, to be honest. Feels as though from a cadence, momentum, velocity, whatever adjective you want to use, things are very much back. From a deal flow standpoint, we see tremendous interest on the part of doctors and their teams in partnering with an organization like DCA. I think a lot of that is, part of it is certainly fueled by some concerns over what tax rate changes might be looming in the future. I think there's also an element of people who are looking back on 2020 and don't want to go through that alone again. And so I think in many respects, I've mentioned this to you, Bill, and some of the others on the panel, that I think one of the things that has resonated with doctors now is that partnerships are not just for times of prosperity, but also for times of adversity. And I think it is underscored the value of having a partner, and hence why I think the combination of those two things and their operations returning to some steady state of normalcy now, as a lot of the impact of COVID is rolled off of the March, April, May, June months. We are seeing a very steady diet of interest in terms of discussions around practices wanting to align themselves with a strategic partner.
Jake, I'll let you kind of take it from there, since you're in a similar situation to David as a DPO. Talk a little bit about what you're seeing.
Yeah, I'll probably echo some of those sentiments. I think last year for us, there certainly was not a slowdown of interest during the peak of the COVID pandemic and the shutdowns and quarantines. We were as busy as ever, kind of fielding inbound inquiries. The obvious obstacle at that time was capital availability and uncertainty on how the dental market and how all these individual practices would rebound. Last year was our busiest year ever in terms of acquisition activity. And that really includes 3 months of the COVID shutdown period where we didn't acquire anything. So we fit a lot in 9 months. I think saw a lot of very deliberate decision making by doctors who are thinking strategically about why they wanted a partner. To Dave's point, 2021, I think, started off, what we noticed is it started off a little slow. It seemed in, maybe the month of January, there was not a lot of interest. And then it really came on very, very quickly starting in February. Saw a massive upswing in interest and activity. I think there's a ton of emerging capital providers and new market entrants. I think if you're a dentist, the day doesn't go by that you're not getting your inbox or your mailbox or your phone hit with some sort of marketing material on why you should sell your practice. So that's certainly fueled a lot of activity from dentists kind of proactively going out and seeking what their options are. I think it's fueled a little bit of a transactional nature I've noticed here this year. It seems like everyone's hearing about high valuations. So instead of a more kind of strategic thought process on why they should do this, it starts more with dollars and cents, which is certainly important. But it's been a busy year. I think we'll easily outpace what we did last year. And it's definitely an interesting market, to say the least.
Thanks, Jake. Yeah, well, definitely want to get back to that high valuations point, because that's a question that has come up about practice valuations now and what you're seeing. Ro, talk to me a little bit about what you're seeing. So with DSO strategy, you're working with a lot of different DSOs, and small and large, and probably private equity as well. So what are you seeing from that point of view?
Yeah, I think in 2019, you saw a need to look internally at your operations and make sure the foundation was solid and get back to basics. So maybe, for a lot of smaller groups, it was one of the, probably the quintessential, but one of the first times, frankly, that some of them faced adversity in their young kind of lives. And so not looking at M&A activity and looking at the less sexy stuff of operations and blocking and tackling and making sure that the people were in the right places, or the operational protocols were really being followed. And so I think that coming out of 2019 into 2020, I almost feel like they were able to, if they needed to, shore up their core business. And now, kind of to the point on the table, they're able to say, okay, well, now I'm even more confident that I can add locations, or I can grow, or I can look to a strategic at a potential acquisition, because I'm stronger than I was maybe in 2019.
That's great. Rich, maybe you could give a perspective, since you're exposed to not just dental, but other healthcare verticals. I mean, have you seen any differences, and what are you seeing from your clients?
Yeah, so 2020 was was a year like we're never going to experience again for a lot of reasons. The government mandated shutdowns obviously impacted not just the dental community, but they impacted physician practices across specialties. And when your doors are closed and you're not seeing patients, guys like me aren't very busy doing deals. We're busy out there talking to our clients, trying to share perspectives on what we think is going to happen, what are other people doing and reacting to. But 2020 was quiet, and it was quiet during those months. But once we reopened and saw that V-shaped spike back experience, it started to give the market confidence. And when the market starts to have confidence, they start to open up capital sources to be able to fund growth. And dental continues to be an extremely attractive investment industry, both for lenders and equity investors. And that's evidenced by what we're seeing today. So jumping forward 12 months from June of 2020 to June of 2021, we are now in a market that is more robust than anything I've seen in my 20 plus years of investment banking, and certainly over the last 10 years in the dental community in particular. And a lot of it is driven by investor interest in deploying money into high growth areas like dental, and ones where there's very fragmented market and an opportunity to create value for the practices in which they partner with. And those phenomenons are driving the level of activity that we're seeing. On the supply side, we're seeing an increase in activity from the dentist perspective as well, who have all been observing what's going on in the DSO community for the last few years, getting educated on what it means to be part of a DSO. And as the DSO community itself has evolved over the last several years, there's a lot of different alternatives that are out there for people. And having gone through all the disruption with their practices last year and all the chaos that it caused, and in many instances, pushed people to the economic limits, they're now looking at the DSO community as a real opportunity for them to become part of it, whether selling practice completely to a DSO consolidator, or maybe looking for a partnership type solution that allows them to continue to participate on the equity side as well. So we're at this very interesting inflection point in healthcare, in the dental community, but then also broadly across other specialties as well, where the proliferation of investors, both on the debt and equity side, continues to grow and offer opportunities for practitioners to be part of this, both to drive clinical performance and to benefit from the economic uplift that provides them opportunities to benefit financially as well.
Excellent. So I want to tag this next question on, because it's relevant to what you're talking about with how robust things are. And this question came up in different iterations, probably half a dozen times, from the attendees, from people that registered for this. Percentage of the market that is currently consolidated. So practices that are affiliated with the DSO or maybe a group practice. Rich, any concept of what that percentage might be?
Yeah, it ranges depending on who you speak to and how you calculate it. But I would say we're anywhere from, call it the high teens consolidated to maybe the mid 20s. So call it, maybe 17, 18% up to 25% consolidated. But I think the real point is that we are still in the early days. I know it feels like the DSO community has been consolidating the market for decades, and it has been. But we need to remember that the dental market is massive. It's one of the largest specialty areas in healthcare across any service specialties. So we've got a long way to go. And just last year alone, and I calculated the amount of consolidation that occurred in 2020. So amongst the 50 largest DSOs, and there's far more than 50, but just amongst the 50 largest DSOs, including DCA and MB2, obviously, the market consolidated or grew by 12%. And those are the private equity-backed groups grew their overall platforms by acquiring or affiliating with practices, and that represented 12% growth in a market where there was almost no activity for almost 3 months, so 25% of the year. So I would expect that we're going to continue to see consolidation kind of in that mid-teens growth year-over-year basis. Maybe 2021 pushes up to 20% growth, but we've got a long way to go, and we've got a lot of opportunities out there. And I think as the market continues to evolve and offer, new ways to align with practitioners, we're going to continue to see an acceleration of consolidation in the dental community over the next 5-10 years.
Thanks, Rich. Does anybody else have any input on that number? Okay, I've got another question, and I'll ask Ro this, and feel free, Jake or David, to contribute. There's been talk for a long time about consolidation at the top, and really didn't see a lot of it until it looked like last year. All of a sudden, the latest was Heartland and American Dental Partners. You had Smile Brands and Midwest. You had some other big way at Aspen and Clear Choice. So they're starting to see some of that. Ro, do you expect, speaking to some of these groups out there and some PE, this to continue? Are we going to see that, or are we going to see more of the 1-2 small emerging groups being rolled up into either an MB2 or a DCA?
Yeah, I think that consolidation of consolidators is going to continue, where it could be something that has so much synergy or makes so much sense, like when Aspen acquires Clear Choice, and they're like, well, this is essentially like a bolt-on specialty capacity, and almost could be like it forms a hub and spoke model of a group that has 900 plus locations, and it just makes a lot of sense. So I do think that consolidation amongst consolidators is going to continue at this like accelerated pace.
Anyone else on that? Jake, do you see that? You feel like that's something that's going to continue?
Yeah, I have no reason to disagree with what Dr. Rowe said. I think, the other dynamic that's emerging right now is, all these startup groups who have capital behind them. And some will do well, some will get overextended and get too far out over their skis in terms of leverage or what have you. And so there'll be some of those smaller emerging groups now will be candidates to be rolled into a larger consolidator in the next 18, 24 months, let's say. Others will just continue growing and growing, but I think that's another phenomenon that seems to be picking up momentum right now, just eyeball test from my vantage point. And that'll help drive some of the larger consolidation as well.
Yeah, I think there's been to everybody's point, I think there's been you will definitely see some larger transactions. Maybe interestingly enough, maybe some companies going public. But I think there's been in the last, what are we now, 15 months or so, there's been a reshuffling of the deck, right? The 1 through 5 really hasn't changed. 1 through 6 hasn't changed in terms of the established, I would say, bellwether DSOs. But I think that the 6 through 20, I think what's happened, and maybe it's 10 through 20, right? But I think what's happened is some of those got really big, really fast, and maybe didn't have the appropriate level of infrastructure to support that growth and to support their practices through something that was, to Rich's point, hopefully we never go through again, but was totally unprecedented. And it only exacerbated, I think, some of the shortcomings in terms of the foundations that weren't in place. And so as a result, I think you're going to see some of those assets for sure get consumed or subsumed into some of the larger, more established bellwether DSOs. And then I think, to my earlier comment, I think it'll be interesting. I think, we could see some activity in the public markets, which would be, again, unprecedented, but would be, I think, would be really interesting to see how that plays out.
And I think, if I recall, Dental Corp up in Canada went public recently, right?
Right.
So that's, yeah, interesting. So, you know what, I'm gonna ask this question because I know this is probably, it might be a pain point for Jake and David, but practice valuations. So let's talk a little bit about that. What are you seeing as far as you're looking at these practices in 2021? What are you running into? I mean, are the expectations different? I mean, is it actually, are they actually getting more than they were getting in 2019 or 2018? Let's talk a little bit about that, Jake.
Yeah, I think it's unmistakable. Valuations are higher than they've been in previous years. It'd be hard to ignore the facts on that. A large driver of that is there's just new buyers in the market, and there's new buyers with a lot of capital, and they need to deploy that capital quickly. I think there's an uptick in activity within specialty dental practices, which tend to command a higher premium for a variety of reasons, I guess. One thing I'll say, not to be a detractor, but I think while valuations are up, what is clearly, I think, more prevalent in 2021 is valuations and deal structures are a lot more complicated to understand. And it's not as simple as it's a 6 times multiple of EBITDA, or it's 150% of collections, or whatever. I mean, the deal structures that are being presented to doctors are broad and varied. There is very frequently a component of rolled equity or some sort of investment into a parent company, and the valuation is being presented globally on what the total dollar amount will look like to the doctor over a period of time. So I think, a doctor looking to sell their practice has to kind of think about the valuations they're seeing in chunks and what's important to them in terms of cash up front, rolled equity, what long-term equity value may hold for them, because, being in receipt of 5 or 6 different valuations from 5 or 6 different groups is great. The valuations may look vastly different, but a large chunk of how that valuation is going to play out is frankly going to happen over a period of time and be dependent on how that group or how that buyer performs. So valuations up, yep, for sure. But the complexity is even more noticeable from my standpoint.
David, let me ask you a question about that. I mean, do you agree with Jake? And if so, are the sellers more sophisticated to understand the complexity? And if not, I mean, they could be in a potential situation where they're really not making the best deal for themselves.
I am not opining on the sophistication of the seller, so I'm just going to put that as a disclaimer right out of the gate. I know this. I think I've met every dentist who has a study club buddy or a brother-in-law who's gotten 12 times for a single doc location. So look, I agree with everything that Jake said. Very well put. my recommendation, right, to doctors who are listening in on this or watching this is just be able to do your diligence on who your interested parties are, right, and ask a lot of questions and peel back the layers of the onion to separate fact from fiction. To Jake's point, yes, the complexity of deal structures, I think, is at an all-time high. And therefore, the onus is on both for folks like Jake and I and Rich, right, to explain that to the relevant parties about what's involved in each of the components of structure, and really to understand, at the end of the day, what's the lifetime value of the partnership? Because the close of the affiliation is a point in time. As we look at it, right, it's a jumping off point for the next phase of growth that the doctor and their team and the practice is going to go through with us as a partner. But the value of that partnership is not a terminal point when we become partners. It extends for 5, 7, 9, beyond a decade. And so look at the lifetime value of a partnership. And my recommendation is ask for references. Ask to talk to other doctors. Ask to talk to doctors who have been affiliated for a number of years, and get their perspective on what the lifetime value of the partnership has been. I think the difficult part, right, is there's a lot of wonderful narratives that exist out there in terms of how they have played out in reality, especially for some of the emerging groups who have got a lot of promise of what the future could look like. But maybe not a whole lot of operating history. There's some execution risk there that a doctor needs to take into account when selecting a partner. Now if they've got conviction that the reward outweighs the risk, and they're in a position to make that bet, and that they believe that that particular organization is the best partner for them and their practice, then go for it. But I think ask a lot of questions and make sure that you understand each of the components of the structure that's being put in front of you, and then really understand what the experience of prior partners has been and what the lifetime value of their partnership has been as well.
See a question in the question and answer live here. How do you all see things like mobile dentistry and a range of different teledentistry services affecting DSOs? Maybe I'll start with Ro, and then Rich, if you want to kind of tie into that. There was just an announcement earlier this morning that On-Site Dental acquired Henry the Dentist. So you've got some of these mobile platforms that different ways of delivering care that definitely seem to be picking up some steam. I'm sure that was paused quite a bit during COVID when a lot of the, especially with on-site and nobody being at work, but it looks like there's belief in the model. And so there you see these types of acquisitions. Ro, why don't you start off and tell me a little bit about what you think there?
Yeah. When I think of mobile dentistry, teledentistry, it's all factoring into the most valuable commodity that there is, money value of time and kind of that time calculation. And so I think that mobile dentistry is great because it's going to create access and availability where people would forego going to the dentist or only go on a reactive basis. And then, teledentistry, I mean, coming out of 2020, I think that we've all, the modality of how we're speaking to everybody today, we've all realized that or Zoom calls or any of these things are not 100% as effective as being able to shake Rich's hand, but it is something that is pretty valuable. And I think that just being able to be more familiar with it, the other part of it is, I think that families are realizing that being able to take their kids to the orthodontist for a retainer check or something, they're thinking of, is there a better way? Because they're spending more time at home than ever, many Americans. And so I think that they're really thinking about that money value of time equation and how can their life be more simplified as possible. And hopefully the parent and the patient behavior will drive the providers and the groups or the DSOs to be able to provide more options for convenience for them.
Rich, any feedback on that? I mean, I know some of these, especially if they're more in concept phase, it might be more VC than PE, but what are you seeing?
Yeah, I think Ro hit on the most important point, and that's access. And my experience in mobile dentistry and teledentistry is all around providing access to care to patients who can't otherwise receive it. And when we're talking about that, and I had a client a few years ago who had a big part of their business and growth was around providing solutions to patients who were in markets that didn't have access to regular dental care, and being able to do it through technology where you're staffing the dental office with everything but the doctor, and recording the entire session through the technology and devices that are available, was a way for these patients to receive the kind of care that they would normally get if they were in a market that was more densely populated. So I think access of care in dental and in all of healthcare is a huge topic, and the technologies that we're seeing today and the continued development of those technologies is going to continue to allow us to reach those patients that otherwise would go unseen. And that provides obviously a very clear benefit to those individuals and recipients, as well as opportunities for practitioners and for DSOs and other dental groups, manufacturers, technology, product, fabricators, et cetera, to be able to drive business around access of care and delivery. So it really is a win-win-win.
So Rich, while I've got you here, capital gains in 2022, I've got about 20 minutes left. So this was the biggest question, probably 30 people, maybe more. And I was like, what's going to happen in 2022? And what should I do? Should I sell in 2021? So you can start the conversation off, and I'd love everybody to kind of give me your crystal ball.
Sure.
We're hanging on every word, Rich.
Yeah. Hopefully I don't disappoint. What I tell all of my clients and folks that I talk to, don't sell your business because the tax regime is changing. If you want to sell your business, or you want to monetize, or you want to de-risk, whatever you want to call it, and this is something you really want to do, then yeah, you should do it now before the end of the year, so that you don't miss the window on what is likely going to be an increase in the tax, the capital gains tax starting in 2022. How much of a delta or how much of a increase in the rate, that's anyone's guess at this point. It could be a small change. It could be a very, very large change. I mean, we can go from 20% to 40% in some instances. Now, I'm not a tax accountant. I'm not registered or have the requisite background to opine on tax recommendations. But I do feel like if you're ready to do something now, you should do it now. And certainly, in the summer months here, the window is closing. And so to jump on that opportunity. But I always tell people, do what you would do, what's best for your business, what's best for you personally, what's best for your patients. And that's how you should make your decisions. Don't make them solely based on a change in some type of government structure or tax or other thing, but rather do what you feel is best for your business. Do what you want to do because you want to do it, not because the world around you is somewhat changing in a modest way.
Yeah, that's a great point. This is another question that really kind of ties into that. And Jake and David, you could probably answer this, and Ro, feel free as well. How long? I mean, Rich really alluded to it. You're in the summer months. How long does it take to close a typical transaction? So, Jake, with MB2, what would you say would be, or is there not a typical transaction anymore?
No, I think we've settled into a pretty good cadence just because once we get to the point of a letter of intent, our integration team is starting to work in parallel with us. That's one of the reasons we're able to kind of move so quickly. Once an LOI is signed, we close in 60 days, almost religiously. I mean, for us to deviate from that 60-day timeline is pretty rare, but a lot of the diligence is just insourced with us. We're not going outside for quality of earnings or using a lot of outside legal or outside diligence, unless it is a very large transaction. How long it takes to get from, that first meeting or that first phone call to a letter of intent is a totally different matter. Every doctor is going to move at their own speed. Some doctors are very prompt in wanting to gain an understanding of our organization and how it could benefit them and getting us the information we need to do a valuation. Other doctors, will call you and then it'll take them 45 days to call you back. And then it takes them another 3 weeks just to get you a tax return or something. So we can move quickly and certainly intend to move quickly once the letter of intent is done. But that relationship piece and getting to know you timeline and then that preliminary diligence period is very variable. But we can move as quickly as 2 or 3 weeks if the doctor is responsive and motivated, and we are as well.
David?
Yeah, I'd say a similar. We're right around, I would say, 75 days. Largely driven by the fact that we do Q of E on virtually all of our affiliations. But Jake's point is a good one. I think the really kind of two determinants, right? One is how well organized is the doctor and the practice in terms of delivery of information, and is this they're putting their toe in the water, or are they really committed? And what are the reasons that they're committed to it? Tying back to Rich's earlier comments, a big thing for us is if the primary driver of this is merely taxes, that kind of feels like you're walking away from something and not towards something. And it's not a play on words. We really want to be able to spend enough time, to Jake's point, right, to build a relationship with the doctor and their teams, such that we feel as good about them as they do about us, and that they feel as though they're walking towards a partnership, excited about and wanting to pull us into their practice, and excited about the growth that we can unlock together. If it's purely transactional and it's driven by tax rates, at the end of the day, the affiliation closes, transaction closes, money exchanges hands, and if you didn't get into it for the right reasons, get into a long-term partnership for the right reasons, the chances that that's going to be a successful partnership, I think are greatly diminished. So we spend a lot of time, on the front end, making sure that we are getting to know one another and that we're building a relationship that's the foundation of which is based on transparency and trust and communication, and educating them as much as we can about who we are and the who behind what we do, and vice versa. Such that we both feel as though we're walking towards one another.
Rich, I'm gonna ask this you and Ro this question here. A ton of activity last year with specialty platforms, a lot of private equity interest. So let's talk a little bit about the future of specialty platforms, and kind of what you see there, and which specialty platforms seem to be performing well. I got a lot of questions around valuation. So are some specialty a little bit higher than multi-specialty or GP only?
Sure, I'm happy to take that. So yeah, we've seen an explosion of PE backed or institutionally capital backed platforms get formed in the single specialty world in dental, as well as multi-specialty. We're probably now at about 15 or so private equity backed DSOs that are focused exclusively on specialty. So whether that's orthodontics only or oral surgery only or endodontics only, implants, so forth and so on. I'm not including pediatrics in that number. The number of pediatric DSOs is probably 25 to 35. additional groups as well. But what's driving it? Well, this is a part of the market that by and large hasn't been consolidated yet. So if you look at the number of oral surgeons that are out there in the market, 15,000, and the number of oral surgeons that are affiliated with a specialty DSO, it's in the low single digit percentage, which means that we've got a long way to go. Most of these guys are still independent. And I think with the creation of these specialty only platforms, there is now an opportunity for a lot of those folks who have wanted to remain in their area of expertise and not be part of maybe necessarily a general DSO or a comprehensive DSO. They now have the opportunity to go and partner with one of those single specialty only practices, because philosophically, that's where they want to remain, whether they do it independently as a single practitioner or affiliate/sell to one of these specialty only DSOs. Those are now opportunities that are available to them. Whereas historically it was either, if I want to sell my practice as a oral surgeon, I'm either selling it to another oral surgeon or I'm selling it to a big DSO consolidator. So I think the availability has created opportunity, and the early successes of some folks like Smile Doctors have demonstrated the doctor demand to be part of single specialty only practices. It's not for everybody. Some people like being part of a broader DSO, one that has comprehensive care under one umbrella. And some people want to remain in their area of expertise. And the great thing about dentistry is there's a solution and an opportunity for just about everybody today.
That's great. Ro, do you have anything to add on to that?
Yeah, I would say on the, folks like on the specialty side, like folks like Smile Doctors or USOMS, they've for their respective specialties have created a broader awareness of somebody that maybe by 1 or 2 degrees of separation, they know somebody that has gone through a transaction with a high probability. And so that has, at least for orthodontics specifically and OS, has created at least the idea of, oh yeah, it's possible. I know somebody that's done it. And to Rich's point, it's an alternative to maybe a comprehensive DSO model. And so it gives them the choices and the optionality that maybe they want to be able to make a decision or to be able to continue on their own path.
Great. So let's talk a little bit about practice valuations. So as far as like the process goes, and this would really be for Jake and David, they had a lot of questions wrapped around EBITDA versus production, and quickly, because I know we've got about 9 minutes left, we can probably have another 70 questions to get to, which we won't. But I think it's important. We have a lot of docs, single practice, maybe a couple of locations, that are wondering kind of what to expect and how the practice is evaluated.
Sure, I'm happy to go. It's a pretty succinct and short answer. It's a multiple of EBITDA. So that's how we're looking at practice valuations. That's how we've done it historically. The percentage of production or percentage of collections tends to be something that gravitates more towards doctor to doctor transactions. But for us, right, in terms of, we've got to be able to represent what's the baseline of EBITDA or cash flow that we're underwriting to, and that the drawdown of capital to fund that affiliation is supported by the appropriate baseline EBITDA or cash flow. So that's how we've gone about it. That's how, and in terms of like peeling back the layers of that onion, what drives lower versus higher valuation, I would say, again, pretty succinctly, that's equal parts art and science. We're going to look at what's the historical performance of the practice and the production of the doctor or doctors. What are the prospects for growth going forward? What has doctor turnover been like? Overall staff turnover? What's the strength of the market that they operate in today? Obviously, the more things that point to stronger practice, less turnover, highly productive doctors who want to stay there and, you know, be part of the longevity of the practice and continue to perpetuate the expansion of the brand, higher the valuation. The more that there is that points in the opposite direction, the lower the valuation. So that's the lens through which we look at it, and the standpoint from which we approach it.
It's great info, Jake.
Yeah, a lot of similarities there. It's always going to be a multiple of EBITDA. It has to be, just given the investors that we have. On the art meets science comment, I think it's very appropriate. EBITDA should be pretty academic. When we do our underwriting, we make the adjustments to back out personal expenses and other kind of standard deductions doctors will take on their business. We'll make sure the doctor is in agreement with our adjustments or add backs that we've made. So EBITDA kind of is what it is. But how we determine the multiple tends to vary, and a lot of the variables Dave mentioned are very relevant. Two that we very much focus on are the active patient count and the new patient counts. We found, just on a very sustained basis, those two key metrics are the primary predictors of long-term success or sustainability within a practice. So we very much look at those. Other points that Dave mentioned, like provider turnover, key man risk, market competition, payer mix, all factor in as well. But always multiple of EBITDA.
Okay, thanks, Jake. We're down to about 5 minutes left. So what I want to do is I've got a question for Ro, and then maybe we can kind of wrap everything up with some final thoughts. So Ro, this question has to come up all the time. As you know, there's always something wrapped around Walmart. So impact of Walmart's entry into dentistry. So that's kind of part one there. You can talk about as much or as little as you want on that, or as much as you're allowed to. And then the other that came through, which was through the chat, is, and this could be on the strategy side, Ro, smaller DSOs that must finance some or all cost of acquisitions. What's the industry standard for maximum leverage? So I thought you might be able to answer both of those.
I can start with the Walmart. You know, I think that competition entering the market is always helpful, especially when it's geared towards the patient. And so, you know, Walmart Health, it's the goal is to be able to provide access to care that to folks in a convenient manner, to folks that might have previously foregone getting care, period. And so the thought around, I think it's 160 million Americans go to Walmart every week, and out of those, the average is 2.5 times a week. So if it's already somewhere where you don't need to GPS or find the phone number or do something, and if it's that convenient, you know, physically to you, I think that if that creates more access, I mean, that's going to be better for everybody in overall, you know, broader aspects of healthcare than just dentistry. On the, you know, the leverage side, I'd probably defer to Rich on this, but I think that it's some of it's going to be what you're, you know, comfortable with. The business can sustain more debt, or are you going to have to, you know, come from it with a personal guarantee angle, and how much are the real estate or the assets, the business is going to be cross collateralized, and so I think that some of it is a function of risk appetite as well.
That's great. I don't know, Rich, if you have anything to add to that.
No, I think Ro hit it pretty much squarely down the fairway. So thanks, Ro. Excellent.
All right. Well, you know, we've got about 3 minutes left. So what I wanted to do is just let everybody kind of share their final thoughts. I'm just going to pull up this the screen here so everybody can take a look. We obviously didn't get to all the questions, which we knew we weren't going to be able to, but I will be sharing your questions with the panelists. So if you have any, you can either email them directly. You see their email addresses right here. You can email myself, and I'd be happy, if I can't answer the question, to pass it along to one of the experts on the panel. Like I mentioned before, we're actually all going to be attending the DICOMA event next week in Denver. So you should be able to find us on the floor at some point and say hello. Really appreciate everybody taking time out today. Any final thoughts? I'll give you each a couple of minutes to kind of wrap things up, and then we'll close things out. Thanks again to Patterson Dental for sponsoring this webinar. Great information. Really exciting year in the industry. So just happy to be a part of it and be able to carry podcasts and webinars like this and create articles for the industry. Please reach out to Nick Abruzzo. It's nicholas.abruzzo@pattersondental.com if you have any questions. Thanks to Patterson. I'm going to start with Rich. Any final thoughts?
Yeah, my final thoughts here. We're in a really exciting time here in the dental community. There's a lot of phenomenal businesses out there who've built just tremendous DSO organizations like MB2 and DCA. And I encourage people to get out there and meet these folks and understand what makes them unique and different and how they add value and how they're great partners. For folks that want a tutorial or an education around that, we can be helpful in that respect as well. And obviously, we represent a lot of DSOs out there as well as capital sources. So happy to participate, in any of those opportunities going forward. And thanks for having me, Bill.
Yeah, thank you, Rich. Ro?
Yeah, I think that earlier, maybe it was Rich mentioned that if a seller is interested, there's a DSO or a cultural fit for everyone, or at least the overwhelming majority. And so the point around kind of being selective and asking a lot of thoughtful questions to learn more, because it really is going to be a partnership, and you might be, you're dating at the beginning, but at some point the goal is to be able to get to a potential marriage. And so ask all the questions and date more than one, I guess.
David?
I'm a one doctor type of person, so I don't know what that means, but so you're hearing a common theme here, right? Which is, and I say this to the doctor audience that's watching and listening: do your diligence, find the right fit for you. I'll be the first one. I've said it. We're not necessarily the answer or the silver bullet for every practice and doctor that exists out there. If you want to grow and you want to continue to expand your brand and you're committed to a long-term partnership, we're a great fit for that. But I would say, make sure that you really understand the people that understand each of the parties or people or organizations with whom you're speaking, what their history is, what their results have been. Ask for references. There's no better conversation than a doctor-to-doctor conversation in terms of somebody who has stood in your shoes and has made the decisions about, selecting a partner. And ask them, why did you pick one organization over another? Or what was it that was kind of the gravitational pull to pick the partner that you picked? So that you can get that same level of conviction and excitement. And again, back to my earlier comment, you feel like you're walking towards something. But that I encourage everybody to do that. Otherwise, it's a transaction, and the dust settles. And after the transaction, if you really didn't, really work hard on the front end to understand who you were partnering with, I think the prospects for success are diminished. And on the opposite, or to the contrary, when you do that and you are excited, you're pulling that partner into your practice. And I think that's a really powerful formula for success going forward. So,
Jake, you're last up.
Yeah, thanks, Bill. Probably a little bit of repackaging what a lot of people have already said. Don't if for the doctors on the call, whether you're a buyer or seller, whether you're thinking about selling your business in the near future, or you're a buyer looking to grow your practice, if it's overly transactional in nature, I don't think it's going to succeed long term. So I always say start with the why. Like, why do you want to sell your business, or why do you want to grow your business outside of just money? And not to diminish the importance or the impact of money or the equity value that all these doctors are working to build, but there has to be some other reasons to do something as strategic as a transaction or a partnership with, the most valuable asset that these doctors have built in their career. So start with the why. Why do you want to do this? Come up with a good thesis on what you would want in a sale and a partnership, or what you would want to achieve in growing your practice, and go from there.
Great. Well, thanks everybody. We went over a couple of minutes. Appreciate everybody listening in, watching us. We will have the recording up in the next couple hours on Group Dentistry Now. And until next time, I'm Bill Newman. Thanks to the panelists for being here today. And this is the Group Dentistry Now DSO Study Club. Thanks, everybody.
Thanks, Bill. See you guys.
Thanks, Bill.